There is no investment out there like that 9 times out of 10. What will change your life is a consistent investing strategy that applies across all assets and all asset classes. So, if you ask me, should I invest in this thing that this guy mentioned on YouTube? I mean, why not? Maybe look into it. Do some research. Google the person. Google the company. Let me see here. If they're registered with the Securities and Exchange Commission, that's a big giveaway that they're somewhat legit. Think about liquidity. Also, liquidity is really important. Liquidity meaning how if you decide not to invest anymore, or you don't want your money in there anymore, can you get your money out? That's very important because you may run into a financial emergency, things like that. A lot of people don't think enough about liquidity when it comes to investing. And so they'll find some investment, like, I don't know, my cousin's liquor store. And your cousin got you to put your $50,000 of life savings into the liquor store. Well, now the money is sunk into the company and you can't get that money out. Right. And you say to your cousin, hey, I want to take my $50,000 out. And your cousin says, I don't have $50,000 to give you. I have a liquor store that's generating, $3,000 a week or whatever, but I can't give you your $50,000 back. So don't just pick investments based on which ones are going to make the most money. Liquidity is important. The stock market, the greatest benefit of the stock market is that it's very liquid. I can make a big investment in Microsoft today and pull my money out tomorrow. And Microsoft is not going to tell me they don't have the money to give me my cash back, right? So ultimately, what I would encourage you to do is maybe do your due diligence. If you like it enough and you want to invest, go ahead, sure. Put a percentage of your portfolio in. Don't put more than 2, 3, 4, 5% in any one asset, and then you can see what happens. Okay, maybe look at the track record. If this is brand new, be really careful because brand new stuff goes bad. In fact, one of you asked me. In fact, that was the last question that was submitted. And by the way, if you want to leave me questions, just log in at theblackstockmarketprogram.com. That's theblackstockmarketprogram.com. You can leave me questions for the following week. So you say, can you decipher this, Dr. Watkins? Now I'm gonna read your statement out loud, Derek. Derek King is the person who submitted this question, and I'm gonna read your statement out loud, and then I want to read it out loud because I want you to hear how it sounds out loud. And then I'm going to give you my interpretation, like my simple answer to this question. Okay, so the statement is here. It says, can you decipher this, Dr. Watkins? Nash Digicoins streamed with our U.S. Federal Reserve Board Fed-approved Wall Street Fund risk transfer strategy. All early participants will live on Nash Digicoin below a penny pricing before it starts trading in Coinbase, Binance, Crypto.com. Okay, so give me maybe in a word or two what you are thinking as I read that to you. Like, I literally read it word for word. Somebody give me a response. Tell me what does that sound like to you as you as I read that to you. Yeah, it sounds very confused. Confused is a good word. Risky, yeah. You know what it sounds like to me? It sounds like the people that created this investment that they are asking you to put your money into, that they are not, from the United States. It sounds to me like they are, that it's brand new. It sounds to me like it could be a fast money scheme. One of the things you got to look out for is since the pandemic started and since crypto kind of took off, you basically have had a lot of people that are in a gold rush right now. They're in a gold rush because basically they said, okay, there's a lot of suckers out here that are giving away their money very easily, that are so desperate for the next get rich quick scheme that if you just sell them anything, they will buy crap in a box, because they think the crap in the box might be worth more money later on. That's what's going on. I remember watching a long time ago Ice Cube's movie Players Club, and I remember laughing about how excited the strippers would get when the ballers would come into the strip club. I'm not a strip club kind of guy. I did have to go to a strip club once because I was the best man in the wedding, and as the best man, you have responsibility for the groom. So I had to follow him as he went to the strip club, and it was really fascinating to see the culture, the heavy, intense culture around strip clubs. Just as a man who likes to stay out of stupid situations, and as a married man, I'm not into that so much. But when I was there, I'm a scientist too. So while I was there, I was observing, just how deeply embedded the strip club culture is in Atlanta, and it was really fascinating. Also, I was really extraordinary. I was really impressed. Strippers are really athletic. I didn't know that. I asked one of them. I said, "You seem like an athlete. Like, did you do a sport in high school?" This is how nerdy I am, right? And she was like, "Yeah, I did gymnastics and basketball." And I was like, "I can tell. Like, the way you did the splits and climbed the bar and hung upside, that was impressive, right?" So anyway, because being naked, that ain't no big deal. Who cares about that? So anyway, but here's the thing, right? So where how did I end up talking about strip clubs? Well, I laugh about that because when I remember watching the movie Players Club and how excited they got when the ballers came into the club, like, damn, VIP girl, they throwing money around, girl, right? It makes me think about what some of these crypto creators are thinking when they see the crypto's taking off. You've got so many people who have been just firmly convinced that people will literally buy anything. So they are okay. It's a poll, not a bar. Okay, thank you, Kevin, for strip clubology. I appreciate that. I'm gonna keep that in mind. Thank you. But it was a bar actually. There was a bar like above. I kid you not. They were swinging from the pipes. Like, I'll never forget that. They were up high, and I was like, "That's really dangerous, man. I wonder if OSHA is aware that somebody could fall and crack her head. That would be bad." But yeah. So it's a tough sport. It's a dangerous. It was. I was whoa. Anyway, let me stop. I'm being silly. But here's the deal. So effectively, you have a lot of people that see money in the air because of the energy that's out there, right? There is a huge amount of sentiment toward FOMO, fear of missing out, buy the dip, right? So because of the FOMO, you're buying the dip. You'll buy the dip on anything, and you'll buy anything. You have a fear of missing out on the next big thing. You're thinking, dang, Dogecoin tripled or quadrupled, and I could have got in on that. I'm mad I didn't get in on that. So there are people that are playing on that. Like, they're putting stuff out that's garbage, and they're saying, hey, this is the next Dogecoin. This could be the next Bitcoin. This network is going to take off. And then they invite you to these little webinars. Anybody ever been invited to these like investing webinars where they tell you about their new crypto and how it's going to be worth $1 trillion one day and all this other stuff? I would just be really careful with that because a lot of that stuff is so bad. A lot of that stuff will cost you everything. That I don't put that in the same arena as investing. It's really speculation and gambling. And also, just to tell you, who makes money during times like this, whenever there's an emotional frenzy, the people that make the most money are the rational people. Warren Buffett always said that you want to be fearful when others are greedy and greedy when others are fearful. So what that says to me is that you have to observe the environment and not get caught up in the nonsense. If you think about, for example, the California gold rush, the people that made the money were not the speculators. In the California gold rush, most of the people that speculated and were trying to get rich from gold never got rich from gold. They never made any money in the gold rush. The people that made money were the people who saw the environment and said, okay, all these people are going to rush for gold. But when they get done speculating, they're going to be hungry. They're going to need a meal. So I'm going to create a restaurant right at the bottom, at the base of the mountain, so that when you get done chasing gold, whether you made money or not, I'm always going to get money because you're always going to be hungry after you've been out digging for gold all day. Or Levi's jeans said, when you're digging for gold, you have to get on your knees and your legs are tired and your knees get worn out. So you need rough blue jeans that you can wear on your knees or on your body so that your knees don't get worn out. So Levi's made a ton of money selling jeans to all the people who want to speculate on the gold. When athletes go broke, my theory is that when you hear about athletes that lose all their money, like Clinton Portis, who actually, unfortunately, I think he hit some criminal charges on some kind of fraud or something he ran, which was unfortunate because Clinton Portis was the highest paid running back in the NFL. And I remember the story 12 years ago where Clinton Portis was sitting outside his investment advisor's office with a gun, threatening to go in and kill him because this man had lost all his money. Well, a good investment advisor is not going to lose your whole $10 million. I would like to see exactly what he invested in and what his thinking was as he did it. What I'm speculating probably happened is that he put Clinton in a lot of deals that were being run by his friends, where you can structure a deal where it's basically like this: it's heads I win, tails you lose, or maybe heads we win, tails you lose, but I never lose. Right. So what a lot of the managers might do is set up a deal where Clinton is taking all the risk. He's putting up all the capital, but they're going to get paid no matter what. They just get super paid if the deal succeeds, right? And they say, "Hey, look, we won. Look how much money we made." But the deal doesn't work out. They say, "Oh, sorry, you lost $1 million, buddy. I feel for you." But guess what? If you look at the contract and look at the fine print, they were collecting fees all the way across the board, fees and salaries and everything else for their friends. Salaries and fees are not risky. There's nothing. There's no speculation in saying I get a 5% finder's fee no matter what happens with the deal. There's no speculation in saying I get a 2% managerial fee. There's no speculation in saying my cousin Ari is going to get a salary of $200,000 a year for running this venture. But there is speculation in being the investor, especially if you're not an informed investor. So effectively, what I would encourage you to do is, right now, especially now that it's raining in the stock market, now that you're having all this chaos, the market is bleeding big time. I don't know where it is right now at the time of this recording. I'm looking here. It looks like the market today is down about 488 points. So it did actually have a little bit of a dead cat bounce, meaning that it did go up a little bit from what it started at this morning. It started out dropping by 550. Right now, there's a huge flight to quality. People are moving to quality assets. They're not really messing around with long-term speculative assets. The stocks that are getting beat down the most are the companies that aren't making earnings yet, because these companies are only surviving because of bank financing, right? A lot of these companies, this is the benefit of being white in this banking system, is that they're able to go to the bank and borrow, $100 million, $200 million, or whatever, that allows them to operate and function even when they're losing money. They can bleed money. I think Uber could go, I forget how many, or it was either Uber or Twitter that they said could go like 100 years and bleed money for 100 years and never run out of cash. That's a pretty powerful position to be in. That's very, very liquid, right? Well, in this environment with interest rates going up, it becomes harder to be liquid because cash has a price. There is a risk in going to the bank and having to sort of re-up your financing or renew your financing in an interest rate a rising interest rate environment. Okay, so kind of keep that in mind as you kind of think about what's going on in the future. So a lot of the companies that people are recommending, and I actually, if you log in at the blackstockmarketprogram.com, theblackstockmarketprogram.com, I listed about 6 stocks that I really like. I bought about half of them. Some of them I didn't buy. I just found them for you guys. It's part of the class. And these are stocks that have a couple of things. One, a lot of them have pricing power, meaning they can increase their prices even in an inflationary environment. So inflation is not going to really hurt those companies as much, because as they increase their prices, they can keep their profit margins the same. And then 2, these are companies that have strong balance sheets. That means lots of cash that will help them survive even if the economy crashes. The big risk factor right now is really stagflation. If you have slowing growth, remember I told you guys one of the drivers of this inflationary pressure, of this of this economy right now, is the fact that consumers in America really have the banks of the corporations. Have the backs of the corporations. Consumers in America spend like crazy. Like, we just spend. It's part of our DNA. It's part of our thinking. We just love to do that. Well, what if consumers stop spending? If they stop spending, then it's game over. And you better hope that if they do stop spending, that it cools off inflation. The problem is that inflation is not just being driven by high demand, right, which can push inflation. It's also being driven by supply chain problems, so low supply. So if the supply chain issues are still there and consumer demand starts to drop, that's when you run into a stagflationary environment. The Fed does not know what to do with that. The Fed is to some extent, they're almost out of answers, because then at that point they're running up against a really difficult problem that is kind of the economic nightmare for most of the economists that are out there. All right, so what I'm gonna do is answer some of your questions you guys submitted today. Okay, so let's see here. Do you consider liquid stocks to be savings? That's a good question. So it sounds to me like you're saying, like maybe instead of keeping your money in a savings account where you're not going to get any, ROI, any interest off that account, would you instead maybe keep it in, a quality stock, and treat that as a savings account? There are people that do that. There are people that maybe will put their money in, say, an S&P 500 Spider Fund or something, or maybe a really safe security, one of the top companies in America, or whatever, and still earn like the return that comes from owning the security, but still have the liquidity and the financial security necessary in the event that something goes wrong financially and you have to pull some money out to pay a bill or whatever, you lose your job or something like that. I don't think there's anything wrong with that. It is risky though. It is risky, right? Like, so let's say that you put your money into Google, because Google's a strong, stable company, or Microsoft. Well, Google and Microsoft, are always doing great. Like lately in this environment, since the start of the year, a lot of these strong companies have been getting their butts kicked a little bit, and it's not because there's anything necessarily terrible happening. It's because everything happening before the fact was so good. The market was doing so well. So you're going to have a natural correction in that environment. What do I think about stocks like AMC? I mean, if you want to gamble, yeah, but if you don't want to gamble, then I don't think AMC is a good look. All right, so let's see here. What about Zynga? Activision was bought by Microsoft. Should I buy more Zynga? That's not out of the question, because that acquisition, in case you didn't see, Microsoft made a bid for Activision, for I think $65 billion in cash, or 68 billion or something, and the price that they bid was like $95 a share, which was far higher than the price that the stock was trading at the time. So as a result, what happened is that the price of Activision stock went way, way up to about $89 a share. Now, the problem with that, though, is, well, what's interesting about that is, think about it. If Microsoft paid $95 a share, then why isn't the stock price of Activision up to $95 a share? Well, because the deal isn't done yet. The deal's not completely done. And I was interested because I like Call of Duty. Like, I started playing video games with my son, and it's so much fun. Now I play by myself because it's so much fun. And so it's a good deal for Activision. The market did not like the deal from Microsoft. Microsoft stock dropped 2.5% when the deal was announced. And remember, from what I understand, if I'm not mistaken, the deal is still a bid. So what can occur though, and the reason the stock price didn't go all the way up to 95 is because the Justice Department, or the Fed, or the DC, the politicians may decide to not let the deal go through. They may say, look, this violates antitrust law. We're not letting the deal happen. Most experts I've seen believe the deal is going to occur. So if you wanted to make some money on Activision stock, not to say that you should, this is not investment advice, but what a person could do is buy some Activision stock at 89, and then when the deal goes through, the price goes up to 95, you make $6 a share. Not out of the question. Some people are going to do that. All right. Let me see. Next, or you could actually buy it at $89 a share, buy 100 shares, and if you had $8,900 on you, and sell the options, right? Which are probably pretty pricey given the upside of the stock at this particular time. All right, and that might be a strategy. All right, so let's see here. Frederick says, I own 47 stocks on Cash App. How should I manage that? I think 47 is a good number. I think you're nice and diversified. I would kind of look and see. I would pay attention to how your portfolio responds on a day like today. Did everything drop? Did everything drop kind of at the same rate, or were there some stocks that dropped more than others? If a lot of your stocks drop more, by more than what the overall market did, that might mean you have too many tech stocks. A lot of tech stocks are very, sexy and exciting, but a lot of these, pandemic plays, the DocuSigns and Zooms and all that, a lot of people are not so excited about those companies anymore. So you got to be real careful with those companies, because a lot of people believe that they're significantly overpriced. I would tell you, Kathy Wood, woof, she was a superstar in 2020. She's like the financial version of Andrew Cuomo. Remember how in the start of the pandemic, Andrew Cuomo was like a national hero, and then a year later he was like out of office, and they, he was a criminal. Well, I think that's kind of what you see with Kathy Wood right now. Kathy Wood did really well during the pandemic. She was the smartest person on the block. This year, she looks like the dumbest person on the block. I think I think Kathy Wood's smart. I like her arguments for long-term growth of the companies that she owns. I do wonder if she overpaid for some of them, but I do think at the same time that by consistently buying into the dip and dollar cost averaging over time, I think a Kathy Wood style, ARK investing style portfolio will be beneficial. It just might not be beneficial in 2022. But if you're a 5-year, 6-year, 10-year investor, I have no doubt that the industries that Kathy Wood is investing in are going to absolutely explode. Tilray, should I buy the dip in Tilray? I haven't researched Tilray. If you log in at the blackstockmarketprogram.com, you can actually, or if you go to boycewatkins.com and just look for the Black Stock Market Program, click that link, leave that question for me next week, and I will research that stock for you and give you a direct response next week. I haven't followed Tilray. I know Tilray's in cannabis. I believe deeply in cannabis. I think cannabis is going to do well. I would consider a diversified portfolio in cannabis, because even though you know cannabis is going to eventually do well, you don't know which cannabis company is going to do well. All right, so let's see. Doc, what is the restaurant equivalent of Chipotle? What's the next Chipotle? I have no idea what the next Chipotle is. Again, log in at the blackstockmarketprogram.com. I can research that for you, and I can give you an answer next week in class. All right, let's see here. Frederick, should I sell some of the tech stocks? I'm not a fan of selling when the market dips. I just kind of feel like it's temporary. Remember, one day is nothing. 5 years from now, you won't remember this day at all. Stock wise, you just won't. Think about it. Do you remember? Tell me, give me a yes or no. How many of you all remember exactly what happened on January 18th, 2017? How many of y'all remember exactly what happened that day? Not January 19th, 2017. Not January 16th, 2017. I'm talking about January 18th, 2017. Do you remember how that day was different from the day before it, or the day before that, 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 or the day before that? No, you don't. You don't remember any of that. So you're not going to remember. Only reason you might remember today is because I'm telling you right now that you won't remember. So maybe you'll try to remember just because you're like, that's the day Dr. Boyce said I won't remember. I remember that day because he said I wouldn't remember it, right? So there you go. But you won't remember tomorrow then. You won't remember the day after that, because you have a lot of days, like this, where the market does weird things. People that make a lot of money, let me tell you like this. If you want, I'm gonna share this with you guys before we bounce out for today. The people who did well in the stock market, who made the most money in crypto in the market in the last 6 years, are probably people who didn't even follow the day-to-day trends. They follow the easy, predictable trends. It's hard to predict what's going to happen tomorrow. That's what they call the random walk, like a drunk man walking, like a random lead. Stock market does random things. You can't predict what's going to happen tomorrow and next week. It's very hard to do. What's easy to predict, though, is the next 5 to 10 years. Easy. Metaverse, easy pick. Electric vehicles, easy pick, right? Dallas Cowboys won't do well in the playoffs. Another easy pick, right? These are easy, predictable things. These are things that everybody knows, right? Well, here's the deal, though. So the people who did best in the stock market were not the people who were caught up in the day-to-day movements of the market and making adjustments accordingly. The people who did the best were the people who just said, it's 2017. I think Bitcoin's going to take off. So I'm going to go buy me some Bitcoin, buy me 3 or 4 Bitcoins, and just sit on it like a goose sitting on a golden egg. And one day Bitcoin will emerge and it's going to take off. Bitcoin's trading at 500, 800, 1,000, whatever it was at that time. I think Bitcoin's going to go up. You wake up 5 years later, Bitcoin's trading at 50,000. Boom, you're rich. Easy. Doesn't take any financial training to do that. Patience and delayed gratification takes no training in school. You don't learn those things in school. You learn those things in life. You learn those things from your parents. Apple. Apple stock is 2017. Apple stock's trading at $40 a share. I like Apple. Everybody wants iPhones. I think Apple's going to kill it. I'm going to just buy, 2 shares of Apple per week, every week for the next X number of years. Well, guess what? You're buying 2. Let's do the math on that. Let's do the math. So you're buying 2 shares of Apple every week. 2 shares at that time was about $80 a week, right? 2 shares of Apple each week. So that's about, let's say, 100 shares a year. 5 years later, you have 500 shares of Apple. Somebody do the calculation and tell me what 500 shares of Apple stock is worth. Let's say Apple's trading at 180. What's 180 times 500? I'm gonna do the math over here, and then somebody sees it could be. That's $90,000. So you've been spending $80 a week. People spend that on lunch. Broke people spend that on lunch. If you go to the club every week, you're gonna spend more than that, right? And now you have almost $100,000 in Apple stock. Now you're officially no longer poor. You're no longer struggling. You're doing extremely well. Let's say you were really aggressive, and let's say you bought 5 shares of Apple a week. 5 shares, $40 a share is about $200 a week, right? A lot of you. How many of you, if you knew that you could make yourself rich, could invest $200 a week in your future if you had to? Just out of curiosity, or let's say $100 a week. $100 a week is actually that's less than what a lot of people spend on their car notes. By the way, a lot of y'all spend more on car notes and rent than $100 a week, which is $400 a month, right? So let's say you bought 5 shares of Apple every week. Then that would take that number, multiplies it by 5. Wait, 2.5 times. I'm sorry. You'd have $250,000 liquid, $250,000 liquid cash that you could just pull out anytime. That makes you officially in the class of the rich, not just in terms of net worth, but in terms of economic potential. Now that you've got $250,000, and it took you 5 years to do this. This is a 5-year plan. Ladies, when you meet a man, if you like men that are going to succeed and do well economically, ask him what his 5-year plan is. And if he does not have an answer, then that is not the man for you. Easy choice. A 5-year plan literally takes you from poor to extremely, doing extremely well. You're doing better than 95% of all Americans at that point because you had a basic 5-year plan and you executed that plan. And then you got $250,000. You're officially on your way to becoming extremely rich because now, if you want to buy a house and you want to participate in the growth of the real estate market, it's easy. You pull 30 grand out of your 250, you go put it down on a house. Now you're a homeowner. Now you're not making your landlord rich. You're making yourself rich. Or maybe you are the landlord and somebody else is making you rich. That's another way real estate owners get rich is they get a renter that pays the mortgage for them. It's very, very easy calculation. Secondly, you want to buy more stock, you can easily do that. You can take your money, spread it out into different assets. Thirdly, you want to start that little business. You sit there, you're in a group of, say, other entrepreneurs, and you're sharing, bouncing business ideas off each other. Eventually, you'll run across something that's easy money, something where you can literally invest 10 grand and turn that into 20 grand a year, 30 grand a year, 40 grand a year, just like that. Boom, you're off to the races. Getting things like getting a job is not even in your vocabulary anymore. So you're getting rich without a job. You're getting rich without working. That's how people do it. 5-year plans. So the question I want to ask you today, this is what I want to leave you with as we bounce out, is what is your 5-year plan? Do you have a 5-year investing plan? And can you pick something? If you want to make yourself rich in the next, decade, I challenge you. This is the Dr. Boyce challenge for today. I challenge you to make a basic, simple 5-year investing plan. Like if you believe in the metaverse, there's an ETF called Meta, META. I'm invested in Meta. There's an ETF called Meta. If you believe that the metaverse is going to blow up, the Meta is heavily invested in different assets in the metaverse. Set a plan. Say, okay, I'm going to buy $50 worth of Meta stock every week consistently, and I will not sell any of it. I will not sell out my future at all. I'm not going to get nervous. I'm not going to make crazy moves. I'm not going to have my money shifting all over the place. I'm going to just sit there. I'm going to plant the seed and let the damn thing grow. You do something like that, then guess what? When the metaverse starts popping off, Meta starts popping off with it. Next thing you know, you're doing better than 95% of your friends, including the white ones. This idea that you're supposed to be broke because you're black, that is the dumbest thing I've ever heard. That is simply not true. If you stay broke, it's because you've done certain things that keep you where you are. You can't help where you were born, but you can certainly control where you finish. So what is your 5-year plan? And make it real simple, real basic. Do something very simple, very basic that requires you to simply do the same thing consistently every week and not make any major adjustments to that. Can you autopilot, auto-invest a certain amount of money every week into a certain asset class and never, ever sell, never let it go, not even look at it for 5 years, not even pay much attention to it for 5 years, or maybe watch it from a distance without selling anything? That is literally, if you go back to 2017, that's exactly the play that would have made you rich. If you had simply bought a little bit of Bitcoin every week since 2017, you would be so damn rich that you wouldn't know what to do with yourself. You'd be balling out of control. This is one little Asian kid that started Binance, and this kid back in like 2012 started buying Bitcoin. and he liked Bitcoin, so he kept putting money into Bitcoin consistently. This guy is now worth $100 billion. He's like 32 or something. 100 billion with a B. $100 billion. That's like Michael Jordan times 50. That's like Oprah Winfrey times 40. Like that's an insane amount of wealth. And it came from just sort of believing in something and consistently investing in that thing and not getting, nervous because the price was going up and down. Right. So don't let these day-to-day fluctuations fool you. That's for entertainment. But long-term investing requires just long-term consistency. Consistent people are the ones that tend to make the most money. All right. So anyway, guys, I'm gonna go. If you want to see the stock picks and everything else, or leave questions for me next week, just log in. Go to Boyce. You can go to BoyceWatkins.com. Look for the stock market investing class. You can log in from there, or go to the BlackStockMarketProgram.com. Also, Friday we're doing that level up conversation, the one-day mastermind. Only 8 people. Again, there was 2 spots available when we started class, 1 or 2 spots. I don't know if they're still available now. If somebody went over there and signed up now, then it's not available. But if you want to talk to me specifically, directly, face to face about your financial plan for your family or about your business or anything, some people want to pitch me stuff like that. The mastermind is the place to do it. So you can go to BoyceWatkins.com. The mastermind link's right there at the top. So feel free to go take a look. And we're going to do this Friday. It's kind of an experiment to see what a mastermind would look like, where I could really help you the most. So anyway, guys, I'm out of here. Have a good day. It was fun. And I'll see you guys soon. Take care now. Bye-bye.